Hey, welcome to the Grant's Interest Rate Observer podcast. My name is Jim Grant, and with me today is the deputy editor of Grant's, the great Evan Lorenz, and Eric Whitehead is at the dials. And this episode of Grant's On Air is brought to you by eFinancial Careers, the world's leading financial services career website. Discover career-changing opportunities across the industry, from leading brands to niche firms. Why not take the hard work out of job hunting? Register today and let recruiters find you. So check out the site eFinancialCareers.com. Hey, John, speaking of jobs, I see, according to Bloomberg, that restaurants are not hiring as they did. And, that would be a very big deal because restaurants have been in the vanguard of such employment growth as we have had in this none too dynamic cycle. What do you see as the editor of Restaurant Finance and Franchise Times? You have a wonderful overview on the restaurant business. What are you seeing in the way of employment?
Jim, when I talk to restaurant owners across the country, they tell me it's still difficult to find people. Hiring is their number one problem. It doesn't surprise me that restaurant hiring would slow down a bit because the industry has been in a slump really since last summer of 2016, especially in casual dining where restaurants are actually being closed. But it's also the sales slump impacted even fast casual restaurants, which were the hot growing area of the restaurant business.
Hey, John, what does that say about the state of business activity in this country when kind of 13 or 14 months into industry-wide soft patch in dining out? Is that indicative of something to do with the consumer, or is it a cyclical thing specific to the restaurant world?
Judging from the reported comp sales of many restaurant chains, you'd probably say the middle and low-end consumer isn't doing very well. Now, there's other factors. There's restaurant competition. There's a lot of restaurants that have been built since the recession. The grocery stores have been offering more restaurant-related type products. But just judging from the comp sales of a lot of the chains and all the discounting that's going on in restaurants, you'd have to say maybe the middle and low-end consumer is stressed.
Hey, give a carpenter a hammer, he's going to say it's a hammer. Now, wait, I got that maxim a little bit wrong. But we at Grants, admittedly, are somewhat preoccupied, if not obsessed, with credit, interest rates, and the like. And we see in the persistence of low rates and easy access to leverage finance, what we see is an invitation to overdoing it, to overinvestment, and to a general blight of muchness. Now, is it conceivable that at least the aggressive building, not the overbuilding of restaurants, owes something to the credit and interest rate environment?
Yeah. If you take a look at the restaurant industry, the low rates have done a couple of things. One, it's made it really easy for franchisees to borrow and to service debt because rates have been so low. Recessionary spreads on franchisee debt might be 400 to 500 basis points over an index, which is usually LIBOR. Today it's 200 and 300. You've got large national banks and regional banks financing franchisees, vying to competing to put money out. There's a lot of leverage that's been added to these franchisees. It's also helped the big chains. You look at Yum Brands or Burger King, Wendy's, Jack in the Box. They, post-recession, decided to embrace this asset-light strategy and sell their company stores, become pure franchisors. And the fact that the rates were so low, the capital availability, there's a lot of willing buyers, and that drove valuations up. Now, you take a look at today, we're almost a year and a half into a restaurant industry that people are saying is slumping, and we see it in comp sales, yet capital is still plentiful, rates are low, banks are still vying to make loans. So yes, it has impacted the restaurant industry.
John, and something I think you've written about a number of times in the past that kind of ties together easy finance and kind of the asset-light model. You say it's not just the franchisors who are going asset-light, but the franchisees are trying to monetize their assets too. Could you talk to us a little bit about what they're doing and what it means for future recovery values on lending to franchisees?
Franchisees, I've been following franchisees since the early 80s. I actually was a franchisee back in the early 80s. Restaurants used to get financed one by one, unit by unit. And you'd buy the land, you'd build the building, you'd equip it, and you had to sometimes finance each of those transactions. So you'd have a real estate loan and you'd have an equipment loan. And it took a long time and it was expensive. And you thought real carefully about building restaurants. It took a lot and it was expensive. Today the way the deal works is that there is a huge net lease market out there that likes to own restaurant real estate. So franchisees over the last 5-10 years have decided that they can build more stores, own more stores, buy more stores if they don't have their capital tied up in real estate. So franchisees, just like the franchisors, have adopted this kind of quasi asset-light model where the real estate in a lot of these franchise restaurant locations are owned by an investor, owned by someone else. And that's fine. That's okay. It's just that when you own real estate, you own it, borrow against it. When you lease real estate, the rents go up every year. And so over time, it cuts down on the operating margins of the franchisees. What does it all mean? What does this environment for the franchisee mean? It's allowed franchisees to get bigger. And so you take a look at Yum Brands, Burger King, they're relying on fewer and fewer franchisees to operate their system. And where a risk might possibly come in is that you've got fewer and fewer franchisees operating these restaurants around the country. I mean, I've heard Restaurant Brands International talk, Burger King, that they would like to have as few as 50 franchisees in the country. Well, you take 50 franchisees, you lever them up. It's not like it was 10, 20 years ago when you had in Burger King 600 franchisees and the majority of them owned their own real estate. It's a very levered system the way it's currently configured.
When we look at kind of the largest Burger King franchisee, which I believe is Carroll's, they're a favorite franchisee. They have the right of first refusal to acquire restaurants in 20 states. Burger King, Restaurant Brands International actually owns a stake in them. And when I look at their financials, it seems like profit's going down and it's not a very profitable business to begin with. What's going to happen to these large franchisees come the next cyclical downturn or an upturn in interest rates?
There's three things that can impact those franchisees. Actually four. Sales could go down, commodity costs could go up, labor costs could go up, and all of those things. Now, sales in Carroll's have been steady, not great, but they've been okay in the Burger King system. And interest rates could go up. And if interest rates go up, the carrying costs of debt to service that debt will go up. And so one of those four things will impact Carroll's. What's interesting about Carroll's is a typical franchisee in the restaurant space. Now, it's a larger franchisee. In our rankings, I think it's ranked number 4 in the country in terms of size. They're doing what a lot of the large franchisees have done over the last 5 years. They've been able to borrow, they've been able to acquire other franchisees and build up their base of restaurants. You mentioned their right of first refusal. That's allowed them to pick up a lot of stores in those territories where they hold that right of first refusal. But other franchisees have grown as well by buying up other franchise restaurants and also buying up company stores that the big brands have been selling. How do they do that? They borrow and then they sell their real estate and lease it back. That's how all of this stuff gets financed, and it adds a lot of leverage to the franchisees.
John, who owns all this real estate that sits under fast food and casual dining restaurants?
There's a number of different. First of all, probably the largest owner are a number of real estate investment trusts to focus on the restaurant business. There's Realty Income, there's Store Capital, there's Spirit Realty. These are all Four Corners Real Estate. These are all publicly held real estate investment trusts that own retail and restaurant real estate. There also are individuals, developers, real estate owners, trusts that own retail and restaurant real estate. And one of the reasons they like owning this kind of real estate, generally these leases are written in a triple net fashion, which means taxes, the maintenance, and the insurance of those properties are taken care of by the tenant. And so it becomes the rental income becomes an annuity to the owner. And this is it's a huge investment area in the United States. And one of the reasons it is so big is, and I don't want to get into the tax consequences of this, but the federal tax laws provide for someone to sell a piece of real estate and exchange into another piece of real estate without paying a tax. Restaurant real estate is really a high demand asset for those types of people.
In terms of the cycle, is there any difference in terms of who's the incremental buyer of restaurants and franchises today versus previous cycles?
It's interesting. If I go back to the 80s and 90s, the restaurant business, capital in the restaurant business came from the public markets. We had a run of IPOs in the 1980s and 90s. That's where most of the growth capital came from. Today, you have private equity funds instead of public investors driving the restaurant business. And why is that? Well, the public markets have changed to where smaller companies, for various securities reasons, have been unable to go public, and so the private equity funds and even family offices have come into the space. They've filled the void that the public market, when the public markets left. There haven't been as many IPOs. In fact, I think the last IPO in the restaurant business was in 2015. There just hasn't been a lot in the last 10 years, 10, 12 years. And it's had to been made up by private capital, and that's where private equities come in a big way.
John, thank you. This is just terrific. Of all the trade publications we see, I must say, for my part, I think Restaurant Finance Monitor is certainly the best written and oftentimes, John, the funniest. You find quirky things and amazing facts having to do, for example, with the piling up of leverage, which always attracts my eye. Thank you for doing what you do, and thank you especially for being with us today.
Thank you, Jim. Appreciate it.
So long. Talk to you soon, John.
Take care.
A word now on eFinancial Careers, the world's leading financial services career website. Just go there and see what they've got. That you can create a profile, let recruiters easily match you to their open roles. You can save jobs and create alerts to stay informed of the latest opportunities. You can upload your resume and cover letter to quickly apply for jobs. So check out the site. That's efinancialcareers.com. efinancialcareers.com. Hey, Evan, you came up with something that I thought was just amazing the other day, and that is that although the world economy seems to be kind of jogging along with, they're seeing some very, very strong economic data, at least the rhetorical kind of data, that is, the survey stuff. The Tenkan survey in Japan, I think, is the strongest in 2007, and there are similar sightings in China and elsewhere. But to me, paradoxically, in the context of this perceived strength, is continued, indeed record, creation of credit by the world central bank, specifically Japan's and Europe's ECB and Switzerland.
Yeah, I mean, if you pick up a paper, you hear global synchronized recovery. You'd think it's a pretty good time, but if you actually look what banks are doing, the ECB is buying exactly 60 billion euros worth of bonds each month.
That's what, $70 billion or thereabouts?
Yeah, 70 billion and change in dollars. The Swiss National Bank tries to manage the franc against the euro, so when the ECB prints, the Swiss National Bank prints, and over the last 3 months, it's added about 7 billion to its balance sheet every month.
All right, that's 77 a month, right? Okay.
Yeah. Then the Bank of Japan is in its own QE program, and over the last 3 months has expanded its balance sheet by an average of about $36.5 or $36.6 billion a month.
Okay, that's 112 billion a month or so.
I actually get 114 billion adding up those three, and then you look back to 2009, and the Fed did its first QE program, and over the course of that whole year, it added an average of $112.4 billion per month to its securities portfolio. So if you look right now, we're actually doing more QE through those three central banks than the Fed did in 2009.
Yeah. Well, as I said, an amazing fact. The credit markets certainly have availed themselves of these rates. I think I saw, yes, I did see something. Standard & Poor's has a very, very good data arm called LCD. And LCD reports that the leveraged buyout market is encumbered with easy credit as it has been since 2007, specifically on large transactions involving major companies. Debt financing has been coming in at a ratio of debt to cash flow, or EBITDA, earnings before interest, taxes, depreciation, and amortization. The ratio of debt to EBITDA is now closing in, I think, at 6 times. A significant point for the bank regulators. They kind of tisk at that. And it's a figure that is the 6-to-1 figure. Kind of takes us back 2007. That's when things got very hot and very parlous. So I don't know. I think we're seeing the classic reenactment of the credit cycle, right? It starts out at a time of contrition that follows the bust. So every boom begins in contrition, right? It begins with people saying, boy, just one more chance. I'll never do that again. So that lasts, 20 minutes?
Thereabout.
Presently, the world heals as the world must, and it's good that it does. And people recover their bearings and their courage, and credit becomes more accessible, and very widespread start to tighten. And bankers who had been taught to say nothing but no are now allowed to say yes, selectively, mind you. And that's kind of, let's call that year 2 or 3 of the expansion. And competition intensifies as competition does. And presently, bankers are encouraged to say yes. Never mind this negativity, the boss will tell them. It's time to generate some volume. So the spreads tighten further and loan volumes increase. Balance sheets become more encumbered and asset values rise, thereby validating the decisions of the aggressive lenders. And before you know it, the year is 2017.
Yeah.
Well, it's not a bad year. You're starting to see so many of the same, for example, you're seeing 100-year bonds by the most improbable sovereign borrowers. You're seeing, here's a little factoid. I think we published this in Grant's Interest Rate Observer, so it's true, certainly, and probably startling as well. So here it is. So the European Central Bank began monetizing gobs of sovereign debt several years ago. I think in 2016, it broadened out from sovereign debt, bank-related debt, into investment-grade corporate securities. And I think it's bought in excess of 100 billion euros. And here is the amazing thing. As of this past summer, price at the time of acquisition of 20% of this corporate debt indicated a yield of less than 0. So negative yielding corporate debt. How is that for a concept? I do take the maxim of the nobleman during the French Revolution who said that he would rather have a mortgage on a garden than on a kingdom. That speaks to the ever-presence of sovereign risk, a government arbitrarily exercising its powers and telling you you're not going to get paid. But my goodness, I mean, is it? What are they thinking about? Would you pay a company to take your money?
I sometimes kind of feel that with my cell phone bill.
I know. Well, Evan, nobody's getting any younger. I do wish there would be a denouement because I'm tired of my own foreboding voice. But as long as events call for this kind of voice, we've got to keep at it, right?
Yeah. Well, one thing to remember is there were a lot of mega deals done in late 06 and 2007. Not a lot of them worked out wonderfully. There was TXU, the power plant in Texas, and it turned out that commodities are still fluctuate in price. And when you have a lot of debt, that doesn't give you a lot of room. There was Caesars in Vegas, the casino. It turned out that fluctuations in revenue with a lot of debt is not a great thing for a capital structure. Yeah,
true indeed. And by the time the cycle's ready to turn, most people have decided the cycle's not going to turn. That's the way of the world. Well, ladies and gentlemen, thank you for listening. Evan, it is a pleasure. Let's do this again next week, shall we?
Sounds good.
Eric, thank you. And to our faithful, noble listeners, thank you for tuning in. Till next time, Grant's Interest Rate Observer.